Mayank Mishra now joins us to talk about what's happening in the dollar and how should one read into the comments which have come from Janet Yellen last evening. Mayank, good morning. Thank you for joining us. Well, it's clear that the US administration right now, or the new administration, is not worried about money printing. If that is the underlying case, are we looking at a resumption in the dollar decline?
No, definitely. I think you have hit the nail on the head. We remain bearish on the dollar for some of the reasons that you touched upon earlier. See, the fact of the matter is that US trade deficits have risen significantly over the past year and are expected to rise further. So whether it's a budget deficit or the current account deficit, both those metrics are going to deteriorate further. And the rising funding needs for the US economy, combined with the very low yields in US or the US dollar offers, means that the currency has to weaken further. So we are looking for a broad-based decline in the dollar over the next few quarters.
But don't you think somewhere short dollar trade is a crowded trade?
I mean, I won't call it a crowded trade. It is a well-positioned trade. It's a consensus view on the street. But given that we are looking at some strong macro forces in play here, the ones that I mentioned earlier, in terms of the twin deficits, very low yields. And another matter, another driver that could push dollar weaker is shift in flows, capital flows away from the US to the rest of the world. Actually, so last year, when during the COVID crisis, asset markets took a hit, US dollar as a safe haven attracted a lot of inflows. On our estimate, more than $1.2 trillion of money went into US money market funds. Now, with the COVID situation is starting to look as if it will improve down the line, with the global economy starting to find its foot, we think that that there is room for that significant capital flow to reverse and to go back to emerging markets. And those are very powerful drivers we are talking about. That's why we think that the move that we have seen in the dollar has room to extend further.
Mayank, with this sort of analogy in place, with the bets against the US dollar, treasury yields rising as well, what do you think that recipe could mean for India, particularly when it comes to the liquidity situation?
Sure. So I think we have to qualify the rise in treasury yields. Sure, treasury yields have risen recently from all-time lows, but we are still looking at very low treasury yields, right? With 10-year US treasury yields around 1.1%, and expected to remain there because the Fed has guided for prolonged easy monetary policy. Fed is still buying $120 billion worth of assets every month. So with that backdrop in mind, we believe that sure, US Treasury yields have room to increase further, but we are not looking for a sharp spike in yields. So like our year-end forecast for 10-year Treasury yield is 150 basis points. Now, as long as Treasury yields remain low and do not spike sharply higher, we think that the high yielder EM can perform pretty well given the carry profile, and given the hunt for yield out there in the world. So the likes of India, can do pretty well in this environment. So we remain bullish on INR. We think that, apart from the FDI inflows that we have seen over the past year, portfolio inflows also remain pretty solid. So net, the balance of payment backdrop for India remains very constructive. So, we think that INR has room for further gains, at least over the next couple of quarters.